Hello, my name is Norka Mania. Today I will present for group assignment, which is I start from the introductions. According to Sabapria 2013, a portfolio investment, one created by individual who is not interested involved in the operation of a company, and the international portfolio investment defined by the World Bank as a being investment to accurate permanent interest in the organization operating in a country beside the investor. The diversification of protective policy to shed the investment portfolio from the financial risk, and the diversification investment portfolio securities from the various national companies offer the better risk of return rather than domestic securities. Thank you.
Diversification is a technique aims to minimize risk by spreading it through the method of varying the investments or portfolio, in other words, by allocating portfolio across various financial instrument industries and other categories. Don't put all your eggs in one basket is quoted by Don Quixote Miguel de Cervantes in the 1600s. That's what exactly the quote is talking about. And then there are three types of diversifications, which include across asset classes, within classes, and also geographically. And then stock investors might be interested in stocks of economies that are growing faster and seemingly more appealing than their domestic market. The investor might also take a look at some of the domestic companies that are experiencing their fastest growth abroad. However, please not confirm whether or not the general finding is applicable to non-US stock investment or extents. And it's also notable to realize the system of stock market in emerging economies region based on the World Bank can be divided into 6 parts, as we can see on the screen. That a rational investor would definitely diversify their stock between these economies because they have local relation.
Hello, so now let's talk on the advantages. So the first one is risk reductions. So, for example, according to some study, investors could have lowered their portfolio risk up to 50% through the addition of international stocks. So the second one is higher return due to lower correlations. International diversification will get rid of the non-systematic risk without making any alteration to the level of expected return, hence the lower risk. This happened because the domestic market are relatively uncorrelated with the foreign market compared to foreign assets. Domestic assets are much more correlated with each other. Hence, investor will get the benefit of international diversification to reduce risk. So the third advantages, as an example, investor from the United States believe that both the US stock and dollars are overvalued. Therefore, the investor will look for investment opportunities from other developing countries like the Asias. By doing this, the investor will get advantage from his investments from the country's capital inflow and also their demand for their commodities. Okay, that's all from me. Thank you.
Hi, my name is Fazlina. I will talk about the advantage of international diversification in stocks. The benefits of the international diversification is the global financial markets become more stable. Each country has their own stocks in their respective market. There are numerous economies and markets where one can find various investment opportunities. For example, US economy, German, Japan, and China. The business that operate in these markets have a sizable global market share. If one economy or market does not perform well, it will help to mitigate the risk. The last one is explain the currency exchange rate. Exchange rate has a link with the investment risk. Investment risk can be minimized by diversifying globally due to the low correlation between national financial markets. According to the YKIP, investment risk influenced by 3 ways, which is its own volatility, the relationship between local market returns, and exchange rate adjustment. Investment risk can be minimized by following the Malkovich theory. When the investment risk decreases, the investment will increase. Simultaneously, the exchange rate will increase.
I will explain about risk of international portfolio and investment. There are two types of risk. The first one is currency risk. A portfolio of foreign securities is normally vulnerable to sudden changes in the exchange rates of the respective currencies, since foreign assets are denominated or at least expressed in foreign currency terms. Currency risk can be broken down in two components, which are currency volatility and the association or covariance of exchange rates with local currency return. Next is country risk. Country risk or political risk refers to the fact that a security is issued or traded in separate or and sovereign political jurisdiction than that of the consumer investor. Political risk also involve default risk as a result of government action and general uncertainty about the foreign country's political and economic prospect. To address this concern, the investor must examine the country's economic growth prospect, political changes, and balance of payment patterns.
International portfolios enable investors to further diversify their asset. The information about foreign fundamental is disclosed as portfolio investment. Financial investment is not only subject to current risk and political risk. All these factors determine the international investors' motivation to invest abroad and consequently their investment strategies. Thank you for watching.